Every year, billions of dollars in potential value just evaporates. And it's not because projects lack vision or because the ideas aren't good. It's because they slam headfirst into fiscal reality. See, you've already passed the economic case. You've proven a project should happen for the greater good. But now you're at Gate 4, the final investment decision. This is where all those theoretical benefits have to face the cold, hard numbers on a balance sheet. And if you can't prove your project is affordable, fundable, and sustainable right here, right now, it dies. Simple as that. So in this explainer, we're going to pull apart the financial case using the framework of the Treasury 5-case model. We're going to look at it through three absolutely critical lenses that every single leader has to master: public stewardship, commercial strategy, and project governance. All right, let's get into it.
Okay, this really is the moment of truth. Every grand plan, every beautifully crafted spreadsheet, every projection, it all gets tested against one simple thing: what's actually in the bank. We're officially moving past the what if and into the what is.
So Gate 4 is often called the point of no return, the final investment decision. And you can see exactly why. The whole game changes here. The mandate completely shifts. We are no longer just asking, is this a good idea for society? Now the question is, does our organization have the actual cash, the borrowing capacity, and the financial resilience to survive this thing? To get through this gate, you have to prove without a shadow of a doubt that the project is affordable, fundable, and sustainable.
And this slide really nails a core conflict, and honestly, it's one of the most common mistakes people make, confusing the economic case with the financial case. The economic case looks at things from society's perspective. It asks, should we do this for the greater good? But the financial case? It's brutally practical. It's from your organization's perspective, looking at your balance sheet. It accounts for all the messy stuff, inflation, cash flow, VAT, to ask one single unforgiving question: can we actually pay the bill?
So, the big question is, how do you survive this fiscal reality check? Well, the answer lies in mastering three interconnected professional disciplines. You should think of them as the components of a high-performance engine that's going to power your project right through Gate 4 and all the way to completion.
A truly robust financial case is always a synthesis of these three disciplines. First, you've got CIPFA, the Chartered Institute of Public Finance and Accountancy. That's your public stewardship, your financial conscience. Then there's CIPS, the Chartered Institute of Procurement and Supply, which brings the commercial discipline. And finally, PMI, the Project Management Institute, for rock-solid project governance. Now, they form a single engine. But here's the crucial part. If even one of these gears fails or grinds to a halt, the entire financial case seizes up. They have to work in perfect, seamless harmony.
So let's start with the CIPFA perspective. This is all about one thing: protecting the long-term financial health of the organization. The Prudential Code, for example, makes sure that any borrowing is actually sustainable. It forces you to ask those tough questions like, will the debt payments for this new project consume so much of our revenue that we have to start cutting essential services in 5 years? It's about making absolutely certain your shiny new project doesn't end up bankrupting your core operations down the line.
Okay, next up is the CIPS Perspective, which provides that vital commercial discipline. If CIPFA tells us what we can afford, CIPS tells us how to buy it smart. This is where a conceptual wish list budget gets hammered and forged into an ironclad, legally binding contract with the market. It's about shrewd risk allocation, tying costs to real verifiable indexes, not just a supplier's whims, and making sure your suppliers are financially resilient enough to actually finish the job with you. And finally, we have the PMI Perspective. This is what keeps the project on the financial straight and narrow once the work actually begins. We're moving away from guesswork and hunches. We're using powerful tools like Monte Carlo simulations to mathematically quantify risk and contingency. We're using Earned Value Management, or EVM, to get real-time financial health checks on the project, which lets us spot budget problems before they spiral into a catastrophe.
Okay, so now we've built our engine with our three interlocking disciplines. But a financial case is never static. It's not a document you file away. It's a living thing, and it's under constant attack from real-world forces. So the next step is to stress test it against every conceivable pressure. I want you to think of these 7 pressures as the enemy. This is the checklist your case has to survive: cost escalation, inflation shocks, delivery delays, contingency erosion, budget constraints, funding gaps, and revenue shortfalls. Let me be clear. Your case is not ready. It is not battle-tested until it has been relentlessly pushed and prodded against every single one of these. A failure to plan for just one of them can cause the entire project to unravel. Now, if you want to see a masterclass in financial control, look no further than Apple. By actually owning the tooling inside their suppliers' factories, they achieve this perfect alignment of commercial discipline, that's CIPS, and execution governance, which is PMI. And what this does is it allows them to completely eliminate what's known as the capital risk premium. That's the extra money suppliers charge just to cover their own uncertainty. Apple removes the uncertainty. It really is the gold standard of financial control.
Now, let's contrast that perfection with the early financial failures of London's Crossrail project. An absolute engineering triumph, no doubt. But just look at those numbers. A budget that blew out from £14.8 billion to £18.9 billion. That's an overrun of over £4 billion. The problem wasn't bad engineering. It was that the financial disciplines completely decoupled from each other. Unrealistic cost baselines, fragmented supply chains, and revenue forecasts that didn't pan out. It created a perfect storm. It's a really stark reminder that when you lose control of the schedule and the commercial strategy, you lose control of the money. Period.
So to navigate this complex world, you have to speak the language. First up, the affordability envelope. This is not a target, it's not a goal. It is the absolute, unyielding, hard ceiling of available capital. It's the wall you cannot go through. And revenue consequences? That refers to the project's long-term financial tail. You know, the ongoing costs for maintenance and interest payments that can quietly sink an organization years after the ribbon-cutting ceremony. And here are the tools you use to defend your case against attack. A risk-adjusted budget is how you mathematically strip out that dangerous optimism bias to reflect the true probable costs of the project. And financial sensitivity testing? Well, that's where you run rigorous what-if scenarios. What if interest rates jump by 2%? What if our revenue comes in 10% lower than we forecast? This is how you build a case that can actually withstand intense scrutiny and survive contact with reality.
Okay, so let's bring all of this together now. We've looked at the individual gears of our engine, and we've looked at the pressures they face from the outside world. Now let's see the unified model that delivers that final, all-important viability verdict.
You know, it all comes together beautifully in this structure. Think of it as a pyramid. Everything rests on the foundation of PMI. Can you physically deliver the asset on time and on budget? That's the bedrock. Then, sitting on top of that is CIPS. Can you control the supply chain and the market economics? And at the very peak, the capstone is CIPFA. Does this entire endeavor protect the institution's balance sheet and its future? If a project satisfies all three of those layers, it is demonstrably and irrefutably viable. It's mathematically, commercially, and operationally sound. So if you take away only one thing, let it be this. The financial case is never, ever simply about having money. It is the brutal, disciplined art of managing money through every single friction point that the real world is going to throw at you. It is not a document you write. It's a discipline you have to live and breathe every single day of the project.
Thank you so much for joining us for this deep dive into the financial case. If you found this valuable, make sure you subscribe so you don't miss the rest of our 5-case model masterclass. In our next explainer, we're going to tackle the final piece of the puzzle, the management case. We look forward to seeing you there.
Following that, reinforce the learning outcome through another version of the same lesson.
All right, welcome back. We're continuing our journey through the UK Treasury 5-case model, which, as you know, is this powerhouse framework for looking at big investments. Today, we're tackling the financial case. And honestly, this is where the rubber really meets the road. I mean, you can have a project that's strategically brilliant, economically valuable, but the financial case asks the one question that can stop everything in its tracks. Can we actually afford it? Okay, let's get into it.
So, here's our game plan for today. We're going to start with the big money question itself. Then, we'll look at how this case acts as a gate of discipline. We'll break down the difference between funding and affordability. Super important distinction there. Then, we'll dive into the 3 professional lenses that keep things rigorous, see how this all holds up under real-world pressure, and finally, we'll talk about the ultimate credibility test. Sound good?
Okay, so first up, the money question. You know, this is that critical moment. A great idea has to prove it can actually be paid for. We're not talking theory here, we're talking cold, hard reality. Now, to really get the financial case, you got to see it as part of a very disciplined sequence. It's not some standalone checklist item. No, it's a critical gate that every single major investment has to get through. And this visual right here, it lays out that sequence perfectly. You see, first, the strategic case asks, hey, why should we even invest? Then the economic case comes in with, okay, but is it worth doing? After that, the commercial case asks, can the market actually deliver this for us? And only then do we get to our focus today, the financial case, highlighted there in gold. This is the one asking the really tough, practical question. Can we fund this, and can we afford it? It's only after clearing this gate that a project can even think about moving to the final management case. So the takeaway is huge. Strategic ambition is just a dream until financial reality gives it a thumbs up.
You know, what I love about this slide is how it clearly separates two ideas that, let's be honest, get confused all the time: the economic case and the financial case. So, the economic case, that's all about value. It's looking at the big picture, cost-benefit analysis, value for money, what's the best option for society as a whole. But the financial case, it's all about feasibility. It gets right down to the nitty-gritty. Do we have the funding? Can our budget afford this? Are we fiscally resilient? So, to put it super simply, the economic case asks, is this a good idea? While the financial case asks, can we actually pay the bills for it? Both are absolutely essential, but they are playing very different games.
Okay, so that brings us to our next really important distinction. A credible financial case isn't just one thing. It stands on two essential pillars: funding and affordability. See, it's not enough to just find the cash up front. You also have to prove you can handle the costs over the long haul.
So let's tackle funding first. As you can see from this diagram, big investments almost never get their money from just one place. Nope. It's a mix. You've got government budgets, capital borrowing, grants, maybe some private investment. A strong financial case has to show exactly where every penny is coming from. But, and this is a big but, the timing is just as important. That funding has to line up perfectly with when the project needs to spend the money. Because if the money shows up late, well, that can stall the whole project and just completely torpedo its credibility.
But listen, securing the funding, that's really only half the battle. Then comes affordability. And this is all about capacity. The organization has to figure out if this big investment fits inside what they call its affordability envelope. Can the annual budgets actually handle it? What's this going to do to debt levels in the Treasury? And maybe, most critically, what about the long-term running costs, things like maintenance and staffing, that this new investment is going to create for years and years to come? An investment is only truly affordable if it doesn't end up creating this huge, unsustainable financial headache down the road. So the big question is, how do we make sure all of this is done with real rigor? Well, the financial case gets a massive boost when you look at it through three different professional lenses. This is really where the theory hits the road and meets actual professional practice.
And here they are, the three pillars of solid financial governance. You've got CIPFA, which stands for Public Financial Stewardship. Then there's CIPS, bringing that commercial and procurement discipline. And finally, PMI, for Project Cost Governance. The magic happens when these three perspectives come together. They're all working to answer the ultimate question. Is this investment fundable? Is it affordable? Is it sustainable? And is it controllable?
Let's break down that first lens, CIPFA, the Chartered Institute of Public Finance and Accountancy. Their whole world is public financial stewardship and fiscal responsibility. They're the ones asking the tough questions. Does this actually fit within our budgets? What are the borrowing implications? What's the fiscal impact 5, 10, 20 years from now? The key thing to get here is that CIPFA basically acts as a reality check, a brake, making sure that big, exciting ambitions don't run away from what the organization can actually afford. Next up, we have CIPS, the Chartered Institute of Procurement and Supply. This lens is all about commercial discipline. Look, the financial case isn't just about internal spreadsheets. It's hugely dependent on the contracts you have with your suppliers. So CIPS focuses on things like contract pricing, when milestone payments are made, those tricky inflation clauses. They're also digging into how financially stable your suppliers are. And why is that so important? Because a badly written contract or a supplier that goes belly up can create these massive hidden financial risks that just blow the budget to pieces later on.
And our third and final lens is PMI, the Project Management Institute. This is all about protecting the financial case while the project is actually happening. I mean, a fantastic plan is totally useless if your costs just spiral out of control during delivery, right? So PMI brings that discipline through a realistic cost baseline, making sure there are adequate contingency reserves for all the surprises that will happen, and just relentless cost monitoring. It's the governance that keeps the project on the straight and narrow, financially speaking, every single day.
Okay, so that's the theory. But let's get real. How does the financial case actually hold up in the wild when it's under pressure? And what can we do to protect it?
Because let's face it, major investments almost never go exactly according to plan. This slide really shows the reality of it. They are getting squeezed from every direction. You've got cost escalation, surprise inflation, delivery delays, budget cuts, funding gaps. I mean, the list just goes on. A truly bulletproof financial case has to be credible not just when everything's going great, but especially when it's facing these kinds of intense financial stresses.
And this is where our three professional disciplines make their grand re-entrance, not just as ways to analyze the problem, but as actual layers of protection. PMI gives you protection with realistic cost plans and those all-important contingency reserves. CIPFA protects the project with medium-term financial planning and by stress testing the numbers. And CIPS adds another layer with stable pricing models and contracts and really doing their homework on suppliers. When you put them all together, that's how you build real, lasting financial resilience.
Want a fantastic example of this in action? Just look at Apple. They manage one of the most ridiculously complex supply chains on the entire planet, and yet somehow they maintain incredible cost stability. How do they do it? Through hardcore financial discipline in their procurement, which is a core CIPS principle, by the way. They use long-term deals with suppliers and strategic pricing to lock in costs and make them predictable. And the result? A super resilient supply chain and rock-solid financial stability, even when they're launching mind-bogglingly complex new products.
Now, for a bit of a contrast, let's talk about the London Crossrail project. Look, it's an absolutely incredible feat of engineering, with huge economic benefits, but it ran into significant cost overruns and delays. And that meant they had to go back and get new funding approvals and constantly reevaluate whether it was still affordable. The lesson here is a really powerful one. Financial discipline isn't something you do once at the beginning and then forget about. No, it has to be a continuous, ongoing process of governance through the entire life of the project.
All right, this brings us to our final section, the credibility test. So what's the whole point of this entire exercise? What's the end game? Well, it's all about building a financial plan that is genuinely believable and, just as importantly, totally defensible.
You know, professional financial planning has its own language, and getting a handle on it is absolutely key to being credible. For instance, the affordability envelope, that's not just a budget, it's the absolute hard limit of what an organization can sustain over the long haul. And the contingency reserve, that's not just some extra slush fund, it's a planned, strategically held buffer to deal with the unexpected. Getting this language right is what separates a vague wish list from a credible, professional financial plan.
So if you take away one thing, let it be this. The financial case is the ultimate test. It determines if a proposal can actually be funded, if it can be afforded, if it can be sustained over the long term, and if it can be protected from financial shocks. It is the exact point where big ambitions meet fiscal reality. And when you get the stewardship of CIPFA, the commercial discipline of CIPS, and the project governance of PMI all working together, all aligned, that is the moment an ambitious idea transforms into a financially credible investment.
So in the end, the 5-case model really shows us that successful investments are never just about a great vision. They depend on this kind of disciplined, thoughtful evaluation, where that strategic ambition is balanced by responsible financial stewardship and a truly rock-solid plan for getting it done. Because at the end of the day, what's the point of a brilliant idea if you can't actually make it a reality?